Alright guys, what's going on? Grab a pen and jot this down. Right now, we're going to talk about the federal interest rate hike, 75 basis points. It's a big move. It was expected. It was not priced in because obviously the market dipped. But what's important to realize is that what the Federal Reserve is thinking, I haven't read the release yet, but they always release a report on their two-day meeting when they do these announcements. They've done quite a few of these already, I think 3 of them this year. So there's a lot going on. What can you take away from this? Number one, there's a market correction happening, right? We've been in a low interest rate environment. So I have 2 points on this, on what's going to happen, or what is happening right now that you can probably use for the next 12 to 24 months. First up, correction, right? High growth companies that have are revenues based on valuation, or valuations based on revenues. Technology companies are a really good example of these. Valuations are going to crash. They're going to come back just like gravity. So it's going to come crashing down. There were so many of these companies were just trading at like 10 times sales or something like that, which is crazy to begin with. So that happens. The second thing that's happening that retail individuals are going to feel the most is interest rates have a direct correlation with housing. So as rates rise, I think they've risen 200-300 basis points depending on your mortgage rates, whatever level you're at. The purchasing power for these individuals has gone down by like 20-30%. So it's become very expensive to buy a home. You raise interest rates by another 75 basis points. This is a risk-free rate. You're going to see this become more expensive, and the housing correction is also going to happen. Prices are going to drop at least by 20%. They've already done that. They're going to accelerate the downtrend, and it's just going to sharpen. On top of the fact that purchasing power from inflation has increased, so purchasing power has gone down. The cost to buy a home and do things like that are related to fixed assets has become more expensive. What's interesting is the second point, which I'm going to note, is that there's conflicting points of views from several billionaires on this case that are talking about that, one, you have to increase the interest rate, hike it really quickly, get to 400 basis points, get the risk-free rate up really high, real fast, just to correct the market, fix a lot of the problems that are currently happening. And on the flip side, we got a lot of guys saying, just don't do it, like Kyle Bass, that if you keep raising the rates by 100 basis points, you're talking about an extra $300 billion in interest payments or something like that for the government to pay. It's simply not feasible when you're paying 20-30% of your federal budget towards interest expenses. When you have a huge deficit, you can't afford most of the other programs like Social Security, Medicare, Medicaid, and all these other federal programs. So a lot of this stuff is just at one point you got the Federal Reserve raising rates, but on the other hand, you got the government having to pay more in expenses. So I don't know. I have a feeling that we're going to get this 300-400 basis points, 3-4%, and then it's going to press hard against it, and you could have to flatline it. And I don't know if it's going to be the current administration, the current treasurer, secretary, or someone else. Someone's going to have to come in and just be like, we can't afford 4%. We got to bring it down to 2.5, 2.25, 2/8. I don't know. So it's there's some balancing act. I don't think it's going to happen at this current point. I just don't think this makes sense. There's something about you're forcing the rates up at a moment in time where you're either trying to fight inflation, you're doing something else, or you're just seeing these other factors it's going to really drive unemployment rates higher. It might go up to 4% when companies have to rebalance or reproject and do other things in forecasting. Something's going to happen with the government. Already too many things are happening where the government's intervening with the rate curves on the short term and long term. But if this continues to happen for too long, something's just going to break. And it's already breaking at a couple of points when you see these valuations get distorted really quickly. And they're kind of pricing in what they think is going to happen over the next period of time, 5, 10, 15 years. But the reality is it just doesn't make too much sense when you're at zero and then you bump up to 4% so quickly. It's the right way to do it. But I don't think we just have too much debt. That's the real problem. The debt load is too high. And there's no way to say, all right, this is going to recover, or it's going to make sense. They're trying to break it. Something is going to break. I don't know what it is yet. It may not be meaningful. It may just pass us, but like at a certain point, you're just gonna be like, all right, this part of the economy just broke, and we can't afford it, and it just stagflation or something worse might happen. So we'll find out.